Right now, millions of families across Britain are making the biggest financial decision of their lives based on something that might never happen. They are signing mortgage agreements, stretching their budgets to absolute breaking point, and betting everything they have on one simple belief that borrowing money will keep getting cheaper. But what if they are wrong? What if the very foundation their entire financial future rests upon suddenly crumbles beneath them? Because hidden behind the headlines celebrating rising house prices and falling mortgage rates lies a ticking time bomb that almost nobody is talking about. The entire British property market has become a massive collective gamble. And when this bet goes wrong, ordinary people will pay the price with their homes, their savings, and their dreams. Here at UK Property Point, we believe you deserve to know exactly what is happening in the housing market before you make any decision that could affect your life for decades. Whether you are a tenant wondering if you should finally try to buy, a landlord calculating whether to sell up, or a first-time buyer desperately trying to get onto the property ladder, the information we are about to share could completely change how you think about housing in Britain. The situation is more fragile than estate agents will ever admit, more dangerous than mortgage brokers want you to believe, and more consequential than any newspaper headline has properly explained. Stay with us until the end, because what happens next in the property market will directly affect every single person who rents, owns, or dreams of owning a home in this country. Cast your mind back to autumn 2022 when Liz Truss stood in Downing Street and announced her infamous mini budget. Within days, the property market froze completely. Mortgage rates shot past 6% almost overnight. People who had offers accepted on properties suddenly discovered their mortgage agreements were worthless. Chains collapsed across the entire country. Families found themselves homeless because their onward purchases fell through while their own homes had already been sold. Estate agents described those months as the worst they had experienced in their careers. Buyers who could afford a property on Monday morning discovered by Friday they could no longer qualify for the mortgage they needed. The chaos was absolute and the damage was devastating. But then something remarkable happened. Throughout 2024 and into 2025, mortgage rates began falling steadily. The Bank of England started cutting the base rate. Lenders began competing aggressively for customers. By early 2026, the transformation was complete. Major high street lenders like HSBC nationwide and Barclays slashed their rates multiple times. Smaller specialist lenders started offering deals that would have seemed impossible just 2 years earlier. Some borrowers with large deposits can now find rates as low as 3.4%. The mortgage market has been completely transformed, and this transformation has unleashed a wave of buyer demand that is pushing prices upward across almost every region of the country. The numbers tell a dramatic story about just how much difference interest rates make to ordinary families trying to buy a home. Imagine someone borrowing £300,000 to purchase a house. At 6% interest, they would pay approximately £2,000 every single month just on their mortgage. But at 4%, that same loan costs roughly £1,400 monthly. That difference of £600 each month represents over £7,000 saved every single year. For a typical family, that could mean the difference between struggling and comfortable. It could mean being able to afford childcare or taking a holiday, or simply not lying awake at night worrying about bills. When mortgage rates fall, millions of homes suddenly become affordable to millions of families who were previously locked out entirely. This is why buyer demand has surged so dramatically since rates started falling. People who spent 2 years being told they could not afford to buy are suddenly discovering that properties are within their reach. First-time buyers who had given up hope are returning to estate agents. Families who outgrew their current homes but could not afford to move are finally starting their search again. The entire market has come back to life and estate agents are busier than they have been since before the Truss chaos began. Spring 2026 looks set to be one of the most active periods the property market has seen in years. But here's where the story takes a darker turn that everyone needs to understand. The entire property rally, every price increase, every enthusiastic estate agent, every optimistic buyer is built upon a single assumption about the future. Everyone is assuming that interest rates will keep falling. Financial markets are currently pricing in a base rate of approximately 3.25% by the end of 2026. This expectation has been baked into mortgage rates, into property valuations, into buyer decisions, into lender risk models, and into the advice estate agents give their clients. Sellers are setting asking prices based on the assumption that buyer affordability will keep improving. Developers are launching new projects, assuming strong demand will continue. The entire market is moving as one based on this shared belief about where rates are heading. The problem is that the Bank of England may have very different plans. When you look beneath the surface at the inflation data that central bankers actually focus on, the picture is far less encouraging than the property market assumes. Headline inflation has come down significantly from the peaks above 10% that we saw in 2022. But core inflation, which strips out volatile food and energy prices, remains stubbornly elevated at 3.4%. This is well above the Bank of England's 2% target. Even more concerning is service sector inflation, which measures prices for everything from restaurant meals to haircuts to professional services. This sits at 5% as of early 2026 and shows few signs of coming down quickly. The Bank of England has repeatedly stated that they focus primarily on core inflation and service sector inflation when making their rate decisions. Both of these measures suggest the fight against inflation is far from won. Average wages across the UK economy are growing at approximately 5.2% annually. While workers are understandably happy to receive pay rises after years of seeing their purchasing power eroded, this wage growth creates a serious problem for the central bank. Higher wages mean higher costs for businesses. Businesses pass these costs on to consumers through higher prices. Higher prices lead workers to demand higher wages. This is what economists call a wage price spiral, and central banks fear it because it makes inflation self-sustaining. The Bank of England simply cannot cut rates aggressively while wage growth remains this elevated without risking a return to much higher inflation. The new government spending plans add another layer of complexity to this already difficult situation. The budget announced significant public spending increases, including substantial pay rises for public sector workers and major infrastructure investment programs. The Office for Budget Responsibility estimates these measures could add 0.5 percentage point to inflation over the next 2 years. While this spending might boost long-term economic growth, it adds demand to an economy that is already running hot. When governments stimulate the economy through spending, central banks typically have less room to stimulate through rate cuts without overheating things further. The government wants growth through public investment. The Bank of England wants to control inflation through keeping rates elevated. These two goals are fundamentally in conflict. Global economic pressures make the situation even more precarious. The Federal Reserve in America has signaled it will maintain higher interest rates for longer than markets previously expected. American inflation has proven remarkably persistent, and the Fed is prioritizing inflation control over growth. If the Bank of England cuts rates aggressively while the Federal Reserve holds steady, the pound weakens significantly against the dollar. A weaker pound makes imports more expensive, directly feeding into British inflation. Consider that the UK imports enormous quantities of energy, food, and manufactured goods priced in dollars. Currency weakness translates directly into higher prices on supermarket shelves and at petrol stations across the country. So what happens if the rate cuts everyone expects simply do not materialize? The consequences for the property market would be severe and immediate. Current buyer demand is based entirely on assumptions about future borrowing costs. Many buyers right now are stretching their budgets to absolute maximum based on current rates, comforting themselves with the expectation that when they refinance in 2 or 5 years, rates will be even lower. If rates remain elevated or actually increase, these buyers face severe payment shocks when their fixed terms expire. Someone who can barely afford their mortgage payments at 4% absolutely cannot afford the same property at 6%. This creates forced selling as overstretched buyers find they cannot refinance or maintain their payments. We have seen exactly this pattern before. When rates spiked following the 2022 mini-budget, transaction volumes collapsed by nearly 30% within months. Estate agents across the country reported chains collapsing simultaneously. Buyers who had already sold their homes found themselves in temporary accommodation because their onward purchases fell through. The human cost was enormous, with families separated, deposits lost, and dreams shattered. The current rally is creating the same fragile conditions. Chains are lengthening as market activity increases. If confidence suddenly evaporates, those extended chains will collapse simultaneously, causing exactly the same chaos we witnessed less than 4 years ago. Different parts of the country face different levels of risk in this situation. London and the Southeast, where house prices are highest relative to local incomes, face the most severe affordability constraints. Even small rate increases would price out substantial numbers of potential buyers in these expensive markets. Northern regions and Scotland, where prices are lower relative to incomes, have more of an affordability cushion. However, these regions often have weaker economic fundamentals and lower wage growth, meaning they are vulnerable in different ways. Tenants and renters face their own particular pressures in this uncertain environment. Many landlords purchase properties using buy-to-let mortgages, and these typically carry rates 1 to 2 percentage points higher than standard residential mortgages. At current levels, many buy-to-let mortgages carry rates of 6% or higher. Rental income growth has simply not kept pace with mortgage cost increases. Many landlords are now operating at negative cash flow, meaning they subsidize their rental properties from other income sources. If rates remain elevated, more landlords will decide to exit the market entirely. However, selling is difficult because potential buyers face the same high-rate challenges. This creates a standoff where landlords want to sell but cannot find buyers at acceptable prices. Beneath all the rate speculation and market psychology lies a fundamental problem that no amount of monetary policy can solve. Britain simply does not build enough homes. The country adds approximately 220,000 new homes annually, but needs at least 300,000 to keep pace with population growth and household formation. This shortfall has accumulated over decades, creating a structural supply deficit that keeps prices permanently elevated. Planning restrictions, land availability, infrastructure constraints, and construction industry capacity all limit supply growth. The hard truth is that UK house prices will likely rise in the near term as falling mortgage rates improve affordability and release pent-up demand. Estate agents will be busy. Headlines will celebrate the property market recovery. But this rally is built on assumptions about future rate cuts that are far from guaranteed. The Bank of England faces conflicting pressures from sticky inflation, government spending, global economic uncertainty, and currency considerations. If expected rate cuts do not materialize, or if rates must rise again to combat inflation, this property rally will not simply slow down. It will reverse sharply, trapping buyers who borrowed maximum amounts based on optimistic assumptions. The UK housing market in 2026 sits at a dangerous inflection point. Anyone entering this market, whether as a buyer, seller, landlord, or tenant, must understand they are navigating extraordinarily uncertain terrain. The explosion in prices and demand is real, but so is the risk that it could all unravel quickly. Make your decisions carefully, understand the risks fully, and never assume that today's rates represent a permanent new reality. The future of British housing remains genuinely uncertain, and those who recognize this uncertainty will be best positioned to protect themselves whatever happens next.